Hi there, John Thompson, founder and lead advisor here at SMPL Mortgage. This is this month's strategy, one that I find pretty fascinating. We call it the Prepayment Analyzer. And we're going to really discuss, should you prepay your mortgage or invest your cash or cash flow? This is one of the most common consumer questions out there that people come up all the time in our practice and so forth in terms of planning. And there is no one answer, right? Every answer is individual. However, there is a way to get to that kind of answer as to what is the most appropriate way of doing it, right? So here is the problem. Oftentimes, homeowners are looking to accelerate and pay off their mortgage quicker for many different reasons. Maybe they just don't like debt. They feel like they need to get the mortgage paid off before retirement. They're not unsure. They're not sure of the other opportunities, what they could do, their choices are. They have no way of really analyzing this decision and seeing what might be the best thing. And they've never really not considered, what the impact is going to be of their financial priorities. Right. So where is the opportunity? Right. So cash flow is critical for most families. We know this. How cash flow, obviously excess cash flow, is handled affects your financial security, how you grow your wealth, how you create financial security for you and your family, both today and in the future. So the opportunity really lies around examining objectives, determining the best use of the cash flow, creating a source of cash if there isn't already one for emergencies, short-term emergencies. Identify all the debt that's out there. Maybe there's obligations that have a higher rate of interest than a mortgage. And then really is paying off the mortgage faster than other objectives, things like college funding or retirement or other asset protection type of things. Perhaps there's other, insurance or other things that might be needed to protect the overall, plan. And then what are the tax consequences kind of over time? So the solution really is, an analysis. At least step one is an analysis of this all, right? So, prepaying or investing in cash flow is an individual choice. It involves logical and emotional considerations. The reality is that we can play with math all day long, but that doesn't address the emotional feelings people have about their home, where they live, the amount of debt that might be on it. But we start with the step one, which is an analysis, right? We figure out what are the objectives, how do they feel about it. There's foundational things we talk about: effective percentage rate, what's the real cost of all the debt, then how do we figure out ways to pay it off quickly. Once we know the priorities, is it a biweekly? Is it making an extra payment once a year? Is it a lump sum? Is there some other opportunity to invest money somewhere else that could be available to draw from? Those sorts of things. So my role as a certified liability advisor really deals with this large question for most people and through the process. So how does it work? Right. So, we really start with the thoughts and feelings about the home. So we're going to try and address the emotional aspect of being in a home. But if we can separate the feelings of living in a home versus the financial implications of repaying debt and home equity and a mortgage, then it's great. So then we go on to identifying all the outstanding liabilities, balances, rates. We prioritize those from the highest interest rates to lowest interest rates for prepayment. We consider the safety, liquidity, and rate of return on all the repayment. In other words, each individual decision to prepay or invest, you have to consider: is it safe? Is it liquid? What's the rate of return on this repayment? And then create the plan and then present the plan, obviously, to the client. So here's a case study of a client of mine, mid-30s. They have a $700,000 second home. They get a $560,000 mortgage at a 4.5 rate. The balance is about $418,000. They have about $500 they're willing to commit in extra free cash flow. And traditionally, they've been earning about 6%. So they'd love to pay off the home in 20 years or less. They're pretty stable. They want to make a good financial decision, building net worth. They want to maintain liquidity in their income. They already kind of have a pretty solid case. So we created the plan comparing their $500 cash flow with the investment. We remind them to do an annual review to make sure we can update this plan if needed. And then we show the impact of prepaying directly versus putting it into an investment account. So the analysis shows that ultimately it may be better to invest than prepay. The mortgage pays off in 167 months, but the clients wanted to know it was guaranteed, right? They didn't want to deal with market volatility and risk at the end of the day. So paying it off directly would pay it off in 217 months, which is within their goal of 20 years. So they made the decision simply to go ahead and just prepay the mortgage, despite the fact they might have been able to do it quicker, 50 months quicker, which is not an insignificant amount of time. But again, it exposes them to market risk and things that they weren't completely comfortable doing. So they're saving about $85,000 in this. And then, the goal here was, I still want them to build assets. So any extra payments go towards the investments. We have a wonderful tool that we've built that if you ask us for it, we're happy to give it to you. We may post a link here, but this will allow you to sort of compare the differences and between investing and prepaying. Another quick case study, another couple, early 50s, $850,000 home, 625 mortgage at a 3.25% rate, so a great interest rate. But the balance is down to $596. They have $1,000 in this case to be able to prepay towards the mortgage or other investments. And then they have $50,000 auto loan at a pretty high rate, 7.25%, with almost $1,000 a month monthly payment. They want to have the home paid off in retirement. They have this $1,000 to play with in about 15 years, right? So we reviewed their objectives. Wealth creation is important, is more important and they're willing to take some risk to do it. We identified that the car is a higher rate that should really be paid off first. Their advisor has been managing their money and earning at about over 7% over time, which is great. And we advised the advisor to create a separate pooled group of money so they could clearly identify the money that's invested that would be used to pay off their mortgage at a later date. And even titling the account under mortgage payoff account helps people feel psychologically better about doing it this way. All right, so then we pay off the car first, which then frees up the $995 on the car payment. So now they've got almost $2,000 a month once they get the car paid off. So, so they decided not to put the money towards the house. They put it towards the car, pays off the car in just over 2 years, which saves them $5,300 in interest. Now they've got $2,000 a month towards the savings account, which they can do, which actually has them paid off in 8.3 years compared to about 13 years. Which saves them a tremendous amount of money over time. So they could choose to pay off the house in 8.3 years, which saves them money there. They could also choose to allow the money to continue to grow as well. So another great example of managing the priority of cash flow. And here's the calculator that kind of went with that one as well. So, the idea is solid. It begins with analysis. So, of course, if you understand the concept, have an interest in learning more about it, we're happy to do this for all our clients, partners, and so forth. We do analysis, we review it. Then ultimately, if we choose to go forward, then we engage at that level. So thanks very much, and I hope you enjoy the Prepayment Analyzer.